A brief history of banking. Banking has been around for thousands of years, dating back to ancient Mesopotamia around 2000 BCE, where merchants provided grain loans to farmers. As civilizations advanced, so did banking. In ancient Rome, banks facilitated currency exchange, deposit taking, and lending, services that are the foundation of modern banking. During the medieval period, the Knights Templar developed an early form of international banking, allowing pilgrims to deposit and withdraw funds across Europe. This laid the groundwork for more complex financial systems. The Renaissance period, particularly in Italy, saw the rise of modern banking with families like the Medicis, who pioneered practices such as double-entry bookkeeping. Central banks like the Bank of England, established in the late 17th century, began to emerge, providing stability and regulation to the financial system. The Industrial Revolution in the 18th and 19th centuries brought rapid economic growth and a need for banking services to finance new industries. Joint stock banks emerged, allowing people to pool resources and invest in large ventures. Central banks began issuing paper money, and the management of the money supply became a critical function. The 20th century saw the evolution of the banking system into what we recognize today. The decline of the gold standard, the rise of multinational banks, and the introduction of credit cards and electronic payment systems transformed how people manage and use money. These developments set the stage for the global financial system we have today. The gold standard. The gold standard was a monetary system where a country's currency value was directly linked to gold. This system provided stability, especially for international trade, as currencies were backed by a tangible asset. However, the gold standard had significant drawbacks. It was inflexible, particularly during economic crises like the Great Depression, as it restricted the ability of governments to increase liquidity and stimulate the economy. Countries began to move away from the gold standard in the 20th century, particularly during and after the World Wars, when the need to finance war efforts made strict adherence to gold reserves impractical. The final nail in the coffin came in 1971 when the United States officially abandoned the gold standard, leading to the modern era of fiat currency, where money is not backed by physical commodities but by government regulation. Fractional reserve banking. In today's banking system, fractional reserve banking is the norm. This system allows banks to keep only a fraction of their customers' deposits in reserve, lending out the rest to generate economic activity. For example, if you deposit $1,000, the bank might keep $100 as a reserve and lend out $900. This process effectively increases the money supply because the $900 loaned out can be redeposited into the banking system, where it can be loaned out again. Fractional reserve banking is essential for economic growth as it facilitates lending and investment. However, it's not without risks. Banks are vulnerable to bank runs if too many customers demand their deposits at once. This system can also contribute to inflation if the money supply grows too quickly, and it can encourage banks to take excessive risks, as we saw in the 2008 financial crisis. Types of banks. Let's break down the different types of banks and what they do. 1. Retail banks. These banks serve individuals and small businesses. They offer basic banking services like checking and savings accounts, personal loans, mortgages, and credit cards. Retail banks are where most people do their everyday banking, from depositing paychecks to taking out loans for buying homes or cars. 2. Commercial banks. These institutions primarily serve businesses, both small and large. They offer loans, lines of credit, and other financial products that help businesses grow and manage their operations. Commercial banks also provide trade finance services, such as letters of credit, which are essential for international trade. 3. Investment banks. Investment banks are the powerhouses of capital markets. They help companies raise money by issuing stocks and bonds, advise on mergers and acquisitions, and provide trading and market-making services. These banks play a critical role in facilitating the flow of capital in the economy and are central to the functioning of financial markets. 4. Central banks. Central banks, like the Federal Reserve in the US or the European Central Bank, are not like regular banks. They don't deal directly with the public. Instead, they manage the nation's money supply and monetary policy. Central banks set interest rates, regulate the banking system, and act as lenders of last resort to ensure financial stability. 5. Credit unions. These are member-owned financial cooperatives that provide banking services, often at more favorable rates than traditional banks. Credit unions focus on serving their members, offering lower fees and better interest rates on loans and deposits. How banks make money. Banks make money primarily through the interest rate spread, the difference between the interest they pay on deposits and the interest they charge on loans. For example, a bank might pay 1% interest on savings accounts, but charge 5% interest on loans, earning a 4% spread. Additionally, banks earn revenue from various fees, including account maintenance fees, overdraft fees, and ATM charges. Investment banks also earn through advisory fees, underwriting fees, and trading profits. In recent years, many banks have expanded into wealth management, insurance, and investment products, diversifying their revenue streams. The role of regulation. Banking regulations are essential to ensure the stability of the financial system and protect consumers. Governments enforce regulations that require banks to maintain certain capital and liquidity levels, ensuring they can meet their obligations even in times of financial stress. These regulations also promote transparency, making it harder for banks to engage in risky or unethical behavior. The 2008 financial crisis highlighted the need for stricter regulations, leading to reforms like the Dodd-Frank Act in the United States, which aim to reduce the risk of future financial crises by increasing oversight and reducing the ability of banks to engage in risky activities. The future of banking. Looking forward, the banking industry is likely to continue evolving rapidly. Digital transformation is at the forefront, with online and mobile banking becoming the norm. Fintech companies are challenging traditional banks by offering innovative services that are more accessible and user-friendly. Cryptocurrencies and blockchain technology also pose potential challenges and opportunities for the traditional banking system. Moreover, the push for sustainability and ethical banking is growing, with more consumers and businesses demanding that banks operate responsibly, both financially and environmentally. This could lead to significant changes in how banks operate and what they prioritize in the coming years.